You're listening to Money Never Sleeps Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Greed, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine when it hurts.
You know what it takes to sell real estate?
It takes brass.
I've fallen, and I can't get up.
All right, welcome to Money Never Sleeps. This is a show where we talk about anything and everything that impacts the flow of money from around the corner to around the world. And I want to thank you for joining us. We're going to go over a few things today. I think a bulk of the show is going to revolve around private credit markets. I think, look, there's been a big topic. This has been a big topic. And I think there's a lot of misconception around it. And I think there's a lot of lost opportunity around it too. And I'm going to go over that. We're also going to speak about tokenization, blockchain, and the things that are going on. And I think that, look, in the private credit markets, they've gotten a bad rap. You have companies that have seen some dark days, but at the end of the day, private credit is necessary. Now, I'm going to explain to you why. You have companies out there, just like way back in the 80s, when you had companies, whether it be a Ted Turner, Revlon, and other companies that needed financing, but they couldn't go to a bank. The reason why they couldn't go to a bank is a bank thought they were too risky. Said, we can't bet on that. We can't go and lend you the money to go in and buy MGM or do this or do that, because that's not what we do. You know, you have to, it needs to be a safe investment. It has to, be this, it has to be that. And what wound up happening, they found a savior in Michael Milken, right? With junk bonds. Okay, and say what you want to say about Michael Milken and everything he's done. You know, he took a financial product that was obscure, and he saw how it can be valuable, how it can be a utility, how it can be utilized in a way it would help companies, and it did. It basically sparked, it sparked a revolution of sorts, and that's what I was going to say. But if you look at it, if he didn't do what he did, Ted Turner never would have got his money. We would never have a CNN, a TNT, a TBS. A lot of things would not be the way they are now. And that's the reality of it. And this sparked some of the largest takeovers, the LBOs, from KKR with RJ Nabisco and the like, and a lot of different acquisitions and LBOs that took place because of this. It was a utility that gave a private equity firm the ability to acquire companies. It gave companies that could not go to a bank, it gave them the ability to get financing. Maybe a little high financing, but that's okay. They got financing where normally they wouldn't be able to. Now, fast forward to today. Private credit markets, they are the junk bonds in a different world, right? Different product, different name, same product, same type of thing. Okay, just a little different, So these private credit markets are important. And if you have companies that need to borrow money, they can't go to a bank because they don't qualify in the bank's view of things. They have to go elsewhere. And who are they going to go to? A Shylock? They're going to go to someone and borrow money on the corner? No, they need to go to an organization that can go and lend them the money at a little higher rate. But that lender knows that, hey, this is backed by the company and everything else, and they know what's happening, they know what it's for, and they're on board. If they know that they're going to go and make an acquisition, or they're looking to do something and they need that capital to do so, all right, that gives them the ability to say, okay, we'll lend you the money to do this deal, you can get it done, and we know you're going to be viable, that you're going to be able to pay it back. The thing, and what has happened with this mini shakeup which to me is like ridiculous. But people panic, right? Just like having a run at the bank. Sometimes when you go and you make loans, you make investments, they don't work within a 12-month time frame. They don't work within a 24-month time frame. Sometimes these things take 3, 5, 7 years to come around. It all depends. If you're lending money to a company to do a thing, and they're building up, as long as they're paying you your yield, then you're good. The thing is, when you have investors that have invested in these private credit funds and they're looking to cash out, if all the funds are deployed to various loans that were given to various companies, where are they getting the money from? Now, if they have to go and have redemptions, that's why a lot of them have to stop redemptions, because when you go and you force a redemption, you're forcing them to sell something off prematurely. So if they have to sell off a loan just to give you back your money, to give an investor back their money, they may be losing 50, 100% on the table. Now, that is why you had this situation going on, no question. It's not that the companies were insolvent, no way. They gave loans out where the investors that invested in their fund wanted the money back sooner than they should have. And that's the point. If you're in it, be in it to win it. Okay, if you have funds that you are looking to have accruing value, then you make your investment in the fund and you hang tight. Let them do their thing. All right, I've yet to see a private credit default transpire. They may have. I just haven't heard about it. All right, and you're going to see this continue to happen. And this is the evolution. And I've been saying this for a long time. And even when you look at like digital credit note tokens and private credit note tokens, they were created for a reason. They were created to go and help these private credit funds to monetize and get liquidity without having to sell their assets off. So what's going to wind up happening, and mark my words here, that you're going to have these private equity funds, these private credit funds that are out there, the people that run them, the companies that run them, okay, I don't care if it's a KKR, I don't care who it is. What they're going to do, they're going to say, wait a second, I have a bright idea. Let's put these together. Let's bundle them. Let's create a new product. Let's create a derivative. Let's create something like a mortgage-backed security type of thing. That's going to happen because it makes sense. You don't have to get rid of your asset, but you're being forced into a corner. So you create this derivative, and now you have another bond that can trade publicly, right? And you have it there that encompasses all the investments that you made with the loans. So now if they want to sell, they're selling those bonds. They're not selling the underlying assets. And that's smart. And that's how you protect, what you're doing. All right? Digital credit note tokens, they do something similar. Okay, private credit note tokens, they do something similar. And that's in the digital asset space, right? But what's the difference? You have TradFi and DeFi converging, coming together, morphing together, okay? And you're going to see it more and more. When you have DTCC going, and in October, they're going to tokenize live, real time, center stage, treasury markets. They're going to do this. What's going to happen? They have trillions in their possession. Okay, as far as stocks and equities and bonds and all this other stuff that they have. They're setting the stage for full out tokenization, I promise you. Okay, they're doing it. New York Stock Exchange is doing it. NASDAQ is doing it. CME, they're going to do it. Actually, they said they're going to have 23-hour, 5-day-a-week trading on equities. How do you think they're doing it? Do you think that they're just creating something internal? No, they're gonna start using blockchain and tokenization. You have big J.P. Morgan. They've been involved in blockchain, even though Jamie Dimon kind of says what he says. But the underlying technology is key is key, and they've had it. They've had this stablecoin. They had this stuff. You have a consortium of I don't know 20, 30, 40 banks coming together to have their stablecoin. Okay, you have other stablecoins. You have USDC, USDT, USXM. You have PayPal. You have all this stuff going on. All right, this is the revolution or evolution of finance, and it's going to be fantastic, and it's going to create liquidity. It's going to create, you're talking about global inclusion, when you can go and get involved in a stock and have a fractional part of a stock, right? So if you have a fractional Apple, let's say, or fractional Tesla, or fractional SpaceX, or fractional Nvidia, or fractional whatever, okay, you may just have $10, but you can have a fractional share of that. Now, tokenization of equities. Well, not all these tokens are going to be or have this. They're not going to have the same properties as an equity. Okay, and some of these tokens are not going to have the same property as a bond. However, when you're looking at like the CME, they're going to have derivatives of stocks. So basically, it's for trading purposes, and that's fine. They let you know that's fine. You don't own the stock, you're trading it, you're benefiting from the highs and the lows, and if you're a trader, it works good for you because things settle the way they settle in cash, and that's it, right? But when you're talking about bonds, you have tokenized bonds out there. Now, if they represent a bond, again, it's that type of thing. Is it going to be able to have the properties? That's why when someone tells me they want to tokenize, they want to issue a bond, or they want to do something like that, I advise them to go, think about a digital credit note token. If you are involved in the private credit markets, think about a private credit token. Okay, and if you don't know too much about it, just follow me. You'll learn about it. I speak about this all the time because this is the future of finance. This is the future of finance in your hands. The private credit markets are not going away. They are going to continue to expand because remember, if the private credit markets weren't there, it would impact the economy. And you may think, well, how is that going to work? One company? No, it's not about one company. If you have lenders and you have borrowers, you have a lender that is lending the money, you have a borrower that's taking the money. You're creating an asset and a liability in that situation. But remember, everyone that borrows money and they're using it to buy something else, they're creating income for another company or person or whatever the case may be. They're hiring people. They're having a social and economic impact. You take that away, so goes the economy. That's not going to happen. That's why private credit markets are not going anywhere. They're just going to expand. They're going to grow, and I think it's a fantastic thing as to what they're doing. They get criticized, everything else. Well, they said the same thing with junk bonds. They said the same thing with other things, but they didn't say too much about the derivatives, right? They just let that happen, and that's where we got into 07, 08. Right, but I think that if you have the private credit, the private equity firms that have private credit divisions, or investment banks that have private credit divisions, and they're going to go do this, well, I think it's going to be smart if they are bundling this stuff together and creating a new product, so that they don't have to go and impede their path with the investments that they've made. It's a beautiful thing. And it's going to help them to continue to move forward. And now, I think the private credit markets are going to continue to expand. We're going to see a lot of stuff going on there. And I think that things are just warming up, especially when they start to embrace the blockchain part of it. When that transpires and it's happening, watch out. You're going to have companies that are going to have access to capital. Okay, and these private credit funds are going to have the ability and the access to go and monetize what they have without impeding their investments. And if you're in the private credit markets, if you have a private credit firm or fund and you want to talk about it, reach out and touch someone, because I can clue you in a lot of different things and maybe give you some insight. that you may need. Now, going into tokenization, okay, I think that real world assets across the board are going to be tokenized. Real estate, there was a big thing where at some point they were utilizing NFTs to tokenize real estate and everything else. I personally don't think that is the right way to go. I think if you're going to tokenize real estate, create a token that has fungibility with other things. Create a token that has a value, that it can be fungible with. I don't care if it's a stable coin, I don't care if it's a Bitcoin, I don't care. It can be fungible with other things. That it can be traded on exchanges, it can be traded on OTC desks, it can be traded all over the place. And this is where you kind of, the breath comes out, right? Because now you have the ability to have access, global access to investors anywhere, at any time. So I think we're going to see a lot of commercial real estate tokenizing. If they go down the NFT route, I think that's a mistake. You go the tokenization route, you get pricing, you get validity, you have all your paperwork, you have all this stuff connected to it, and you have high fidelity data, then it's a win. And again, commercial real estate people, holders, they're looking to tokenize, they can reach out to. I can go and give you some guidance there too. Again, with the real world asset space, which is everything, right? So that encompasses everything. You're going to see a lot of interesting things come out. I do say that it needs to be. You need to have the the trust factor there, right? There needs to be documentation when it comes to real world assets. Something needs to be filed legally with someone, with someone, a lawyer or something. I know there are on-chain platforms that do have this. They show the documents and they lock them up in a vault, everything else. But I think it needs to go deeper than that for the protection of the people, because I've heard for too long, TradFi is this, is that, it's never going to evolve. Same thing, the horse and buggy, it's never going to, no one's going to adopt a car. No one's going to adopt and drive a car. No one's going to go and watch TV. It's a fad. No one's going to use the internet. I swear, there were articles that said no one's going to use the internet. It is a fad. What are we doing now? You're listening to this on the internet, right? The internet changed the world. It changed everything. Tokenization will change everything. Now, DeFi. Come on, guys. For the longest time, you had people in DeFi. Oh, DeFi is everything. We don't get involved in TradFi, everything else. But at the end of the day, you have technology, you have legacy. It needs to come together. And it's going to wind up being fantastic. Fantastic for us. It's going to be fantastic for the next generation, and so on and so forth. And again, we're going to see a lot of growth. And this is what I see. We're going to see a lot of growth in the RWA sector. Not all players play the same. You have some bad actors out there, and I'm speaking frankly about it. It's about transparency. It's about trust. It's about seeing things out there. And you just kind of, you need to, make sure that all the I's are dotted and T's are crossed if you're going to get involved in something like that as a buyer. If you are if you have a commercial property, or you have a portfolio, or you have other things going on, or you have other RWAs, whether it be, you can be a refinery, you have gold in the vault, or whatever the case may be. There are a lot of different ways to do it. It has to be done the right way. And if it's done the right way, all of a sudden you have a win. And that's what it's about. That is what it's about. You have, and I want to end with this. The NASDAQ, they basically changed their rules, and a lot of people are freaking out about it. That if your company, I guess your market cap is not above 5 million for X amount of days, that within 30 days you're gone. They bump you down to the OTC markets. All right, now people are barking about that. The reality is, how many companies had a lifeline? And I know one specific company, I'm not going to name the name, but it was the joke of all jokes. It's like, it's like it's ridiculous. It's like, hey, you know what? You want to taste this apple? Yeah, well, bite it, but you can't eat it. You can't eat it, but don't swallow it. Don't do that type of thing, right? Where they would go and they would play the game by doing reverse stock splits, killing their investors just to prop up the price of the stock for their own, without doing anything to help the company. This is why this is happening, to get rid of those people, those companies that shouldn't be public if you can't go and do the right thing. Sometimes companies, you hit a brick wall. I get it. You have companies that go and they play this game. Reverse stock split, to go and boost things up and try to boost up your stock price, to do whatever, and now you get another notification and then you're going to do it again. There was one company that did it like 6 times in a matter of, 14 months. 6 times. Well, NASDAQ got wised. They got wise and they knocked them out. And now that company's somewhere in the pinks for market manipulation, and promotion. Okay? The point of the matter is that the NASDAQ doing this, I think it's the right thing to do for the benefit of the investors. If you're a public company and you cannot raise capital and you cannot go and have a viable business, you shouldn't be public. You have companies that go public, they just reverse into a shell so they can go and push and pump and dump and do all this other stuff. I'm glad they're cleaning it up. And the NASDAQ, again, they're going to go the blockchain route. And what that's going to do for the OTC markets, you're going to see how that is going to evolve, where you're going to get more players in that space. You're going to get more players in that space, because if you think for a second that there aren't other groups out there that are going to get into that space where they can actually go and have a venue for these companies, and for them to do it in a way that it's tokenized and that can interact with what's going on with the NASDAQ or New York or wherever else, it's going to happen. You look at Ethereum. Right, you have BitMine with Tom Lee. They have the Ethereum Institutional Foundation, and what they're doing is they're going and they're making deals with institutions to go build on Ethereum. I think that's fantastic, and what that's going to do, that's going to benefit any blockchain that integrates, not a bridge, but that integrates ERC20 and EVM. If they integrate that compliance and they have that compatibility on a protocol level, it's a win-win-win. It's a win on so many levels. So I think that is fantastic that they're doing that. Anyway, on that note, I think that I covered what I wanted to cover on this show. I want to thank you guys for tuning in. I'm going to come back to you, and we're going to talk about private credit markets, and we're going to talk about other things on the next episode. But until then, I want to thank you for tuning in, and I want to wish all of you that you're extremely successful with your trading today, tomorrow, and the next day. All right, anyway, thank you, and we'll be back with you on the next episode of Money Never Sleeps.
Initiating shutdown sequence.
You're listening to UCW Radio. In your face.
What is your major malfunction?
So let it be written. So let it be done.
Ladies and gentlemen, my mother thanks you, my father thanks you, my sister thanks you, and I thank you.
The views and opinions expressed on Money Never Sleeps Radio are for informational purposes only and should not be construed as financial advice. The host Louis Velazquez and guests of Money Never Sleeps Radio are not licensed financial advisors, and any investment decisions made based on information presented in this podcast are at the listener's own risk. Listeners are encouraged to consult with a qualified financial advisor or investment professional before making any investment decisions. The podcast hosts and guests do not endorse or recommend any specific investment strategies or products. All investments involve risk, and past performance is not indicative of future results.